go ahead and start here. Now, let's thank everybody for attending this week's presentation. Now, what we're looking at here today, now just a little bit about myself here before we get started. I am Greg Firman. I've worked in the futures and Forex markets for the last 12 years, and in 2006 founded eTradeFX, an introducing broker firm and commodity trading advisor firm that advises on the futures and Forex markets on a daily basis. I am Series 3 commodity futures licensed and Series 34 Forex licensed and registered with the NFA and the CFTC as a commodity trading advisor. I have worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading, while providing very specific risk management models with preservation of capital the primary focus, and of course, steady growth. I've further worked as a market analyst for Trader Planet since 2008, a prominent free social media website that globally connects traders, where I provide daily commentary to a large number of followers in the Forex, futures, and of course the stock markets. Now, for today, what we're looking at is trade setups post-FOMC. We're going to be looking at a complete review of the US dollar majors, intermarket correlations post-FOMC and which currencies will likely perform the best, identifiable supply and demand zones, and how to trade them without involving complex fundamentals. We're also looking at multiple time frame trade setups to confirm price action, which again, in my respectful opinion, is something we must be looking at multiple time frames and stay away from these lower time frames. So I want to keep to a very tight 35, 40-minute schedule here because I know I always run over. So let's get started here. The dollar index. The first thing we want to look at here, guys, and make sure we're fully aware of, I'm sure that everybody has read all the things about interpretation of what the Fed has said. My interpretation is I'm not going to spend a lot of time talking on what she said. She didn't really say anything different than we already know. She is not really changing anything other than removing the 6.5 unemployment, which benefits her, not anybody else, because they don't want to be tied to that. The U.S. unemployment can still get to 6.5 and not be creating any jobs. That's the whole thing she's doing here. So they're not raising rates anytime soon. In my respectful opinion, they can't afford to raise rates, and they can't really afford a stronger dollar. So the dollar is going to continue on the way it's been trading, in my opinion, very much like 2013. It's going to have its rallies, and then it's going to sell off, just like it always does. Every dog has its day. Right now, that dog is having its day. So we'll let it have its day or two, but I don't think the long-term play here is buying U.S. dollars, in my respectful opinion. But it's not about what I think, what you think, what every analyst thinks. It's about what the market is willing to buy or what they're willing to sell. Excuse me. So when I look at this right now, we are on the D1 time frame. The first time frame I always look to try and figure out where the market is. Now, right now we can see we are coming up to an absolutely critical resistance point on the dailies. Now, the reason I'll go to the dailies first primarily is because your bigger traders, your real money, they're staying away from the hourly, the 30-minute, the 15-minute. I shouldn't say the hourly. They'll look at the hourly, but I don't think they're trading off of it. But they will not look at the 1 minute, the 5 minute, the 15-minute. They'll ignore that because it's just noise. So we're looking for real price action. The dollar's made some pretty significant gains in the last 24 hours. And when we see big candles like that, very seldomly is there any significant follow-through because it's news-driven. And most of your big traders are never trading the news. Because if we traded the news, then actually we would be, and we took the report from Yellen from basically what it is, we wouldn't be buying dollars, we would be selling dollars because she was very dovish in my respectful opinion. So this is up is down, down is up in trading, guys. That's the way it is. So what we can do is identify some key levels. We have this critical level at 80.50. We need to clear that on the dollar index if Euro-US is going to continue lower, which I will talk about Euro-US, so we'll talk about that. But now when we talk about this, interest rates raised earlier sounds hawkish. Yes, but she didn't actually say that. So the message that came in from Pan on Fire is that she's talking about raising the rates earlier. She didn't really say that. She is saying that the inflation is contained. They're not changing their policy. She did not specifically say that they are going to be raising interest rates sooner. They said nothing of the sort. The market is interpreting that. But when we look at it and break it down based on the economics in her statement, she didn't actually say that. That's my opinion. So I'm looking for hard evidence that she is saying, okay, I am absolutely going to raise the rates. I'm not looking at 2016 now. I'm looking at 2015. She didn't say that. And she certainly didn't say in 2014. So we're, in my opinion, years away from a potential rate hike. And a rate hike based on the U.S. dollar debt, oof, that's not good, guys. That's not good at all. So the U.S. has got to keep those rates down, and they need to keep that dollar weak. They can't afford this dollar to get too strong, or else the whole dynamic changes. So when we look at it from this standpoint, the dollar will probably continue to move a little bit higher. Now, in the previous webinars, what I did talk about was this center Donchian band, which was of concern to me that I wanted to stay above. And you can see that this candle on the monthly started to push below that 79.20 area. That's a bearish signal. But it's recovered. So what I think these central bankers are doing is they're in there playing with the markets. They're stabilizing the currencies. More importantly, their concern is to stabilize those equity markets. Now, what I briefly want to come out here and look at is the intermarket analysis component of this. And when we look at the intermarket analysis component of this, the S&P 500 actually started to move lower about 6 days ago. So it's been trading back and forth, but you can look at this using the Vantage Point software and their predicted moving averages, that essentially when the equity started to sell off, we could start to see a base forming right here on that dollar index. So when we look at this is a very interesting connection here. Now, what I want to do is just connect the dots for a minute here and bring this down, as we see down here that when that equity market started to sell off, the dollar started to recover, and that led to a bigger move, which indirectly to me suggests that somebody knew what the Fed was going to say, and they started moving back into U.S. dollars and out of euros, out of sterling, out of the commodity currencies to some extent. So that's what we see here. So we're looking at that intermarket correlation, which is very high. When we look at gold, we can see that gold pretty much peaked right around the same time as that dollar started to base, and then it started to move lower. And we take notice here, this was 3 days before the FOMC, which clearly points to we've got price moving around back and forth, maybe position size adjustments, but I think more importantly, somebody probably knew what was going on here, and the bigger money was moving out. And this is based on a daily time frame chart. So definitely something I wanted to point out to everybody, how these correlations kind of work. And you can see as oil started to base out and started to move higher, that again is a leading indicator to suggest that the Fed may say that the economy is a little bit better, which she did say. I'll give her that. And that immediately put a bid into oil. But again, you can see that happened 2 or 3, 4 days before the Fed. So everything that's happening is happening before the Fed. Then you have this knee-jerk reaction that comes after the fact. The knee-jerk reaction is what we want to avoid. We want the price to stabilize again, and then we want to start trading again and stay away from the before and aftermath of the FOMC. So we're looking for trades after the fact. So when we look at the key levels here from the from the US dollar index, we need to clear this level. So what I've talked about in the previous webinars, get yourself onto a demo with the Windsor FX. I'm not suggesting to trade live there in any sense. I do not broker for them. I have no affiliation with them. But you can get a real US dollar index live chart here, and it's worth your while. It's free. It doesn't cost anything, guys. I've ran a demo on this for 12 years. So it's worth it to do things like that, so you know what this dollar index is doing. When we look at this on the monthly, again, this allowed me to get a good feeling for the dollar. If I lose this level, and you can see that I have a big trend line sitting right there at 78.91, so we have a massive support area on the dollar here. If we lose this level, you can see that we have, I was going to say a black hole. Well, let's call it a gray hole. And if we lose that, then our target is considerably lower. So when we look at our monthly patterns, I'm going to keep moving so I can get into the currency pairs for you guys. You can see in the monthly time frame, we've had that sell-off right around the 14th. We bottomed out, moved lower, and now we're recovering towards the end of the month. In my opinion, these cycles will continue, guys. There will not be a cycle here where the dollar goes in one direction or the other direction. It's trading simply doesn't work that way. And based on a lot of some of the fundamentals that I've talked about here, the interest rates, higher interest rates do not help the Fed. They do not help the U.S. in any way. They got to pay their debt back. They don't want higher interest rates. So, without going into a whole big thing there, nothing has really changed here in the dollar. This white line that I have right across the screen here, I've talked about that over the last 3 or 4 webinars. That's where we were last year, at the start of last year. So you can see we're pushing above that white line very much like we did back here. So if I bring up my tool here, okay, so our tool here is we can see when it pushed above this white line, it was right in this section right here, okay? And that was essentially about the beginning, towards the end of February, end of March. So we could be in for a big dollar rally here, but as you can see, that big dollar rally also had big swings to the downside. It peaked out right here, okay, and that was basically around June, July, and then it started moving. Just let me move that out of the way. Actually, excuse me. That was more towards July, and then the dollar went on basically a free fall. Down it went. So we could see a bigger rally in the dollar here, absolutely, based on supply and demand, where we were last year, the seasonal pattern. All of this works into that. But we have to clear some key levels. Right now, it looks okay for the dollar. It doesn't look great, but it looks a little better based on what Yellen said or their interpretation of what she said. So the next non-farm payroll, guys, that's going to be a volatile one. If they don't get a good number, then they're going to take everything that Yellen said and throw it right in the garbage and say, nope, she's wrong about everything. Unemployment's no good. It'll just be another free-for-all. So when we start going into our currency pairs, let's have a look at this, okay? Let's have a close look at what's really going on here with Great Britain, U.S., because this is definitely worth a look. Now, we've broken our trend line. We're on the daily. We're starting on the daily, okay? Right here. We've broken through that trend line. We've broken through this blue line and this yellow line that I've talked about in previous webinars, that I use them not for the crossover, but to gauge where they are in relationship to that area. The further the market moves away from this area right here, 165.96, the more likely it is it's going to retrace to it, okay? That's just the way the market is. And, can I explain it? And not in so many words other than to say it usually trumps your Fibonacci, your Elliott waves. We could put all that stuff in there, but it's a little bit of voodoo in my opinion. It's just the market has its natural movement of getting out and going the other way or taking profit, and it sends it the other way. That's kind of what we're looking for here. Now, when we look at this, we've had a sell-off, but the theory here with a longer-term moving average, some people like 50, some people like 100, some people like 200, some people like a 25, 50 cross, all these different ones. I prefer a 100-day EMA, which is between the 50 and between the 200. So a nice balance is a 100-day moving average. And again, that's what we're looking for. So sounds like we have a bit of a sound issue. If I wanted to just get confirmation there, I think we're okay for sound. If not, just let me know on here for our administrator. Now, when we go into our lengthier time frame, okay, I'm getting a message here. Sound is good. Thank you, Leica, for clarifying that. Deara, I would contact the administrator, and she can assist you with any sound issues you may be having. So moving along with our webinar here, if we look at our monthly here on the pound dollar, which is definitely an interesting one. You can see right here on the pound dollar on the weekly time frame, and this is what I want to point out. We had this candle that broke over that 6-day moving average. The next candle went right back up to a 6-day exponential moving average, kissed it, and then collapsed. Very interesting. So we're watching this level right here to determine if this downside move in the pound dollar is really what everybody believes. Now, what I further want to point out is we have significant trend line support down here, 162.70, and this critical level at 163.59. which is the 25-day exponential moving average. All of these represent potential downside targets for shorts and also potential reversal points. That's the key thing, the reversal point. Excuse me. Now, when we look at this, our RSI is broken back below 60, but it's still above 50, guys. But this is a much longer time frame. And the area that I would really watch on pound dollar is 164.17. The 100-day EMA on the monthly, and we have the 6-day exponential. They're sitting right there. So if this thing is really going to turn to the downside, that's the area that we have to get through. So you want to mark that down, write it down, and that's if this is a true rally for the British pound, that area is going to hold, and you're going to see significant buying coming in at that level. So hopefully that gives a good explanation of currently what's going on with the pound dollar. Right now we are bearish. It looks like we are moving lower to that. We've broken the trend line today on the H4. A very, very good time frame to trade. When we go into what we'll do is we'll just have a quick peek at you guys, your short-term traders here. So your hourly time frame, you can see we're starting to get a little bit of a base here, that lower Donchian band. I don't anticipate that's going to hold on the hourly. So I think the 4-hour, I think we're going to go probably lower for a bit. Now, as we look at Euro-US, this is probably the most heavily traded pair in the Forex market. It is not my favorite. I'll be perfectly honest. It's also the most manipulated. And people are getting in, they're getting out, but it is tied to that US dollar index, almost 100%. Okay, so when we look at that, it's, we really want to think, is Euro our best currency pair to really trade? I'd rather go over to US Swiss franc, even though it's technically the same or very similar currency pair. There's less of these wild, crazy swings, that don't make a whole lot of sense, but. It is what it is, and people are going to trade Euro-US, and I'm going to trade Euro-US because that's what we do, right? So let's have a quick look at this. The daily time frame, we're losing a key level right now, and that key level is 137.91. Staying below that and closing below that level, that's bearish. That's definitely bearish for the euro, but we have this center Donchian band at 137.24. If we're really going to turn, and this is a true downside break or a complete trend reversal on this, there's a couple of levels here that you need to know that we need to break. We need to break 137.24, and we need to break 136.57. I'm not confident. My optimism on that happening is guarded. I'm not convinced that that's what's going to happen here. Okay, so what we can do is point out the main levels on the weekly. We're still pretty bullish here. There's that 6 days showing itself again, and that's coming in around 137.83. That's not to say that we couldn't bounce right here, to say the least. But I think we've got a little bit more downside here, but I think the downside is going to be somewhat limited. But we know the key levels. It's not about being right or wrong, guys. It's about knowing the levels and how to play them and react to them when it happens. Most of your traders will not sell low. They will not buy high. So if we're going to sell low, we just need to know where to do it. And if it's really truly a signal here, we are on the 4-hour time frame on the RSI, we're at basically 12.71. We haven't been down at this level for a very, very long time, and when it did, it bounced out of there. So that's on the H4. We're definitely pushing the oversold territory, but on the D1 here, this is showing that a bigger move could be in play, but you can see when we broke the 60 line, the 40 line before, what's happened is there's been 2 or 3 days of pretty good downside, but it's reversed then for 2, 3, 4 days. So be careful of this level right now. And again, if we're looking at that daily, I would say we should be able to target 137.24, but the battle lines are probably going to be drawn right around that area. Now, with U.S. Swiss franc, again, same trade here, guys. I'm not going to spend a lot of time on it for you for this week. In theory, I remember the good old days trading this thing at 117. And we are at 88, and it's still difficult to make money on longs here, right? So, we have to call the dollar for what it is. And when I say every dog has its day, that's what I'm referring to. Because, again, if you go back and look at this thing in the monthly charts, you think, how could this thing possibly go any lower? And then it does. If you look at it right there, you can see 123. That was back in 2008. Okay, and so when we look at this, I know it looks like the easy trade going long here, guys, and I like it. We need some confirmation. We need some real solid confirmation on this. Okay, so when we look at this right now, we are pushing higher on the dailies, but again, there's that area right there, 88.79. I'm more comfortable buying above that level so I can target this upper level around 89.64. The probability of a reversal around this level, within about 50 pips of this level right here, that's a problem. That's a big problem. And this bull trap, everybody on here has been caught in it, and it's not very nice. And next thing you know, Euro-US reverses and US Swiss franc gets slammed lower. We've got some seasonalities that may support the long. Just know your key levels, guys. Real important on this one. Stops on your dailies. Any long trade, in my respectful opinion, the stop should be below 86.97. So if you're taking longs, just know where you need to have these stops. Very important. On the H4, it looks quite good on the H4. We'll see how this particular candle finishes right now. That is a bearish pin bar sitting right up there, or a shooting star, another term for a bearish pin bar. If it closes and this candle closes and looks like this, then Euro-US is probably going to pause where it is and move higher, and US Swiss franc is probably going to start moving lower. When we look at it on the weekly, you can see that we're barely even able to take over the 6-day, let alone the more significant levels up around 89, 83. And of course, the center Donchian band there is at 91.04. So while it remains very low, it's still very limited upside potential in my respectful opinion, unless Euro-US really collapses. When we come into our dollar-yen pair, before we hit our finish up with our commodity currencies, dollar-yen it's a tricky one because the primary correlation is to the S&P 500. So the S&P 500 up, dollar-yen goes up too, regardless really of what's going on with the dollar index to some degree, right? So the yen has been very strong, and most analysts around the planet have trouble figuring out, based on the debt scenario, the money printing in Japan and everything else, it doesn't seem to matter. Whenever there's a little bit of a war or something, they're pouring into the Swiss franc, not as much, but they're really pouring into the Japanese yen, even more so than the dollar. That's what I'm seeing. So this one right now on the dailies, we've got heavy support down here, guys. I've talked about this with my own clients all week. On Trader Planet, I'm warning people also. Right around this 101 area, 101.20, we've got a significant amount of support building. But we can't really afford a big sell-off in the S&P 500. So if you're trading dollar-yen, you need to keep a very close eye on those equity markets and the global situation with Ukraine and Russia. Very important that you watch these events, because if Putin starts acting up again, then dollar-yen's going lower, and it will trump your moving average, it will trump Elliott wave, it will trump Fibonacci. None of that stuff means anything. It's a fundamental play. So as long as you understand the fundamental of it, that if things heat up there, then they're not going to be pouring. They're going to be going into Japanese yen against the euro, Japan, against these other pairs, and that will send dollar-yen lower based on that cross-pair pressure. Okay, so that's the main thing to understand with that one. Now, I like to check during the thing here to make sure any questions or anything looks okay there. Everything, audio things seem fine. That's good. Okay, so when we look at the monthly time frame going into dollar-yen, this is the area that I've been talking about for basically the last month or two. This is where these guys are really, the supply and demand comes into play more so than anything. This is where these guys are fighting it out right here. So we're hugging, again, the 6-day. Simple 6-day moving average, guys, exponential moving average can be your best friend. And it's telling you that if we lose this level, and that level right there is around 101.71, we've pushed below it, but more importantly, we have this trend line that's been sitting there since 2012, okay? So there's your date on this trend line. This trend line here is sitting, basically it's 2 years old. So we know that this area is a huge area. Okay, and we need to get above it. Then we've got that Donchian band that formed at 105.43, another critical level. It's very difficult for me not to say that shorts are heavily favored here. As bullish as this may seem, it needs to get moving. We need to break this trend line. Now, the weeklies, we formed another trend line sitting up here again on the same time. So that's a trend line on the weekly, trend line on the daily. That's a problem. That's a bit of a problem for what's supposed to be such an easy long trade. The best trade, the analysts have said, for 2013, don't forget, the best trade was the U.S.-Japan long. And then they flushed every one of those longs out and drove it down back into the lower 90 area. So, we can't forget what was said there, and that's much like the euro. Remember with the euro-US and why I said it's not my favorite pair? That's because it's not anybody's favorite pair. Like every central banker on this planet has got it wrong. Even the old ones. Greenspan spoke up and said, I could never get that currency right. I couldn't figure it out. Why people were buying this thing. I can't figure out why they're buying it, but they are. So, we really need to know it is really a buyer's and seller's game in there, and supply and demand. Who's willing, this past week on Euro US 139.40, they just couldn't push through that supply zone, and then it collapsed. That could have been different with the Fed. Maybe it still will be, but we have to see. So dollar yen right now, we're long as we hold above 101.20. That's how I'll leave dollar yen for you guys. That keep a close eye on this. You can buy down as close to this level as possible, but keep those stops tight. I mean, 165, 175. Keep your stops around that area. If we lose this area, the sellers will be in full control, and they will just pound this thing down to this potential target in the 98 level. Now, if we can keep moving, if we can hold above 100, then I think we've got a better shot. If we can hold above 101, we've got a shot to get back towards that. It's going to be a slow crawl. So just play the daily ranges on dollar yen. That's the best way to play it. Currencies statistically move 1% of their value per day. That's it. So that's the way. So in 2013 again. Was supposed to be the best long trade ever. That's what I have on my books from every panel, or from most of your economists out there. They used to have Currency in Motion on CNBC. They were all promoting the dollar yen trade as the best trade of 2013 long, and it never made it, and they were all stopped out. So I don't remember anybody saying the best trade was short. Sorry, but as far as I have and everything that I've seen, everybody was getting long dollar yen, and then it crashed, and then it reversed and went long in the latter part of 2013 and in the early part of 2014. Now, as we go into our commodity currencies here, we can see here that we're up against another significant resistance area on the New Zealand-U.S. currency pair. If we look at this on the monthly, we pushed above that trend line. The question is, can we hold above 84.14? So this is an area you want to mark down as a critical support level, very, very critical support level. So when we look at this right now, we're looking at that key level is broken. We've got a big bullish move through the trend line at 83.58. That's the one we sold into that trend line for literally weeks and weeks and weeks, almost months. That the short was a great trade. When it broke, we get stopped on the other side. We go long. Now, on the dailies, we can see that we do have a trend line forming here around the 86.02 level. So we've got a little bit. It hasn't formed yet. What we're going to need is another candle, two more candles to the right to confirm this new trend line area of resistance around this 86.05 level. So if we can hold above 86.05, then we have a shot of moving towards the highs of this currency, which is, up around the 87.93 area. That is entirely possible. And we noticed that New Zealand did make the ultimate high on this currency. It was in July. And that's interesting because that's when the dollar was rallying. The peak dollar rally was right to this point, and it's almost as if New Zealand fell at the same time. So we're looking for how it's reacting right now. You can see on the dailies, we've lost that all-important 6-day. The next candle has opened up under that 6-day. This has a bearish setup, guys. Right now on the dailies, it does have a bearish setup unless we can retake the 85.56 level. Okay, so I'm going to leave New Zealand with you on that one. and go into the CAD. The CAD on the last webinar, several people had asked me on the webinar, should we go long right now? And I said, yes, we should have our stop under the 109.85 area that you can see now. This currency has made a big move to the upside. Now, this is understandable why it did that. We had a significant trend line forming down around this 110.20, 110.40 area, and you can see that it hovered along there. What I want to point out on the weeklies that we had a bullish pin bar, which ultimately led to a sideways candle for the next week, and then the week after, it stayed within that trade zone and then just was driven higher. The data out of Canada has been absolutely horrendous. It has not been good at all, and that is not helping the Canadian dollar. Now, a lot of the manufacturing is leaving Canada. It's going to China, India, Mexico, and this is hurting the Canadian economy. So if you think that U.S.-Canada is too high to buy at 111, when you look at the fundamental picture of the Canadian landscape, it's maybe not as good as what some people think. And we have a great banking system in Canada, but economically, from a manufacturing standpoint, if manufacturing is the backbone of our society and the middle class is the backbone of our society, that middle class is leaving, or it's shrinking because we don't have the manufacturing that we once did. So this puts pressure on the Canadian dollar. It will continue to put significant pressure. We also have political issues here. The Conservative Party they're dropping like flies. This past week, we lost the finance minister has resigned and he's going back to the private sector. The Alberta Premier has stepped down. There's a lot of infighting, very much like the U.S. politics. So these things are, when global traders look at the overall political and economic environment, with Canada, it's maybe not as great as what one might think. So we definitely need to consider that when we go to, like I was saying, a repeat of what happened in the U.S. Absolutely. That pretty much sums that. You can probably hear it in my voice. That absolutely sums it up. And it could even be worse. And, because as the jobs leave, people want government benefits. They want all these things. And clearly socialism in Canada doesn't work. Socialism didn't work in Argentina. It's not working in France. And it's ultimately not going to work in Canada. And that's because at one point, Canada was Mexico. The U.S.-Canadian exchange rate when I started my career was at $1.62, $1.62 Canadian for $1 US. So always remember back, if history repeats itself, then 112 on a long still could be considered pretty cheap, right? So keep that in mind. The only thing is, if the U.S. goes down, usually, in most cases, it takes Canada with it. So I want to make sure I get to all our pairs here right now with U.S. Canada. I'm just going to go back to make sure I outline some key levels for you guys for the post FOMC. Right now, this upper trend line comes in around 111.47. That is the former line. So we can connect the dots to there to a base around a 111.47. If we stay above 111.47, that can be used as a springboard for longs. If we're going to go short, we really need to break this 109.90 area. So your key levels, 111.47, right around that area. If you're going to get back in on longs, shorts, I would be only convinced or more confident with a short below 109.90, and I would still be concerned about that short because we have 109.08. And we have 108.63 providing backup support for this currency, okay, for the U.S. dollar against the Canadian, just to keep that in mind. So going into the Aussie-U.S., because my time is running out here, when we look at this, we have right now on the Aussie-U.S., you can see what's interesting is that is actually a bullish pin bar on the H4, suggesting we may pause out it again right around this area. So a candle formation or a single type of candle, like a shooting star, a pin bar, an engulfing type of candle, can really be an indication of who's in control down around a key support level. Who's got this? Bulls or bears? Which one's winning? Right now, this is an epic battle going on right around this area above the 90 level. If we lose the 90 level and we break through this trend line, that'll set it off on a short-term basis. And when I look at it here on the dailies, it's very, very mixed signal right now. A lot of indecision on this pair. We get good news out of Australia. We get bad news out of Australia. We have buyers. We have sellers. Ultimately, this is a high-yielding currency, guys. That's what it is. Longs are always kind of favored on this currency because of who doesn't like getting paid a dividend on their holding a currency pair for, multiple days or multiple weeks and having the brokers pay us interest. That's what we're looking for. You know what I mean? So longs will always carry a slight edge. We'll see how this candle finishes today. That is a bullish pin bar forming on that daily, but we have to see how the day finishes. But right now, we need to hold above 89. I'm going to call it at 89.50. If we can hold above 89.50 and the 88.72 right in that area there, if we lose these two levels, then that's going to target us down back into the 87 level. It's going to take a pretty significant dollar rally for that to happen, and that's going to be that's going to be an argument. So Pan is saying, what about Chinese trade being worse? Do you really believe the numbers that they're giving you? I don't. Let's face it. China's buying is buying hand over fist. They are buying U.S. debt in exchange for a trade surplus. So they can say they have a surplus or a deficit or whatever. I don't believe a lot of the economic numbers that come out of China, nor do most analysts. It is something to consider, absolutely, and that could drive it lower. But ultimately, we know that the numbers out of China are not the most honest. I will leave it at that and let everybody make their determination and keep an eye. As soon as China puts out a bad set of numbers, then they turn around and put a good set of numbers out. So once again, trading the news, not a great plan. Not a great plan at all, especially if the news is manipulated by the Chinese, which we know it is. So the bottom line is their economy is doing pretty good. In fact, in my respectful opinion, that's the biggest economy in the world, not the U.S. You can take that for what it is. You can run the numbers yourself. I do not view the U.S. economy as the biggest economy. The U.S. is the biggest consumer. They consume like locusts. But are they the biggest producing economy? Of course not. So we have to take that into consideration. So that's why relying on these economic numbers, I always say to my own direct clients, take them with a grain of salt, but always make sure you know where the buyers are and where the sellers are. And you take any kind of an economic data, whether it be the FOMC, the Fed, Chinese data, Bank of Australia, whatever, take it with a grain of salt and focus on price action and where the buyers and the sellers are. Right now, we're losing buyers, but they have not dried up here by a long shot. When we look at this on the monthly time frame right here on Aussie US, we're actually starting to potentially base out here. So if this next candle in the start of April opens up higher than your lowest point right here of 86.58, that's actually creating a new trend line off of here. So buying down into that, if we get down into that 87 area, then that's probably going to be a very good reversal point to start looking at going long. But right now, we're in a wedge formation. We're trapped. There is no clean signal on Aussie US. But we have broken this trend line. Now, there's a critical level on the weekly also, right there at the 91.11 area. So if we can push above 91.11, then we've got a shot. So right now, slight bias to the downside. I would agree with that. But if we break above 91.11, then I would say all bets are off on the shorts, and we're going to start moving higher. So, New Zealand, Royal Bank of New Zealand, they're getting hawkish there too. But the one that's really putting this pair under pressure is Aussie New Zealand. Aussie New Zealand is getting killed. It's down in the 105, 106, 107 level. This is another one that was traded way up at the 140 area. So it's, every time somebody wants to sell Aussie New Zealand, they have to buy New Zealand US and sell Aussie US. That's how the cross pair works and how it influences the market, or how it influences the US major. Now, it's a little different with some of the currencies because China and Japan, for example, they're trading directly with their own currency. They're not using cross pairs anymore. They want nothing to do with the US dollar. They're saying we do not have to go through a cross pair to settle our trade differences. We're going to do it directly with our own currencies. And that story didn't provide a lot of news, and I'm surprised that the analysts weren't talking about that a lot more, because China kind of did it unilaterally without any real fuss from the U.S. from Washington. So it tells me that China's kind of in control here. Well, clearly they're in control with the amount of U.S. debt they're buying every single month. And if they stop buying that debt, where would the U.S. be if China stopped buying U.S. treasuries? Ask yourself that question, because that's a reality in the future, okay? So it's something to think about there to close off the webinar. What I want to do is make sure that everybody has a pretty good understanding the importance of supply and demand, the importance of keeping your analysis relatively simple without complicating your charts. There's a lot of different things that can be used to identify supply and demand. Using multiple time frames to see where that supply and demand is, where are the buyers and sellers conflicted. There's a lot of different ways to do that. Identifying certain candle formations, very, very powerful for taking the lag out of your moving average crossover, taking the lag out of an overbought or oversold signal where it gives you an immediate warning of a potential reversal. So when we look at the Aussie US right now on the weekly, if this candle closes the way it is right here, I'm just going to bring that up so everybody can see it. Okay, where's my anointing tool? Sorry, bear with me. There we are. Allow anointing. So this candle right here, okay, that is a bearish pin bar right there. So this is the weekly time frame. We all know that the weekly time frame is brutally lagging with a moving average cross or with a stochastic or an RSI or a MACD or any of your conventional indicators. But in this particular case, we look to see how this candle finishes the week. And if it finishes the week looking like it does right now, or the bottom of this body continues to move lower and the wick starts disappearing on the bottom, that's a bearish pin bar, and that would suggest that we are going lower on Aussie US. But again, this is just a big balancing act between all these currencies. They have a big rally up, they have a big rally down. But always remember, the currencies statistically, and this is a fact of what I'm saying, they move 1% of their value per day. A stock moves 10% of its value per day. Currencies are not as volatile as people try and make them out to be. It's when you over leverage your account, you are going to have problems, okay? So what we know is, looking back through these time frames, we definitely have some opportunity coming up. I think that potentially they are reversal trades. So we're going to be looking at those key levels. And like I said, I have no problem selling low, or buying high, providing I clear certain levels. If I don't clear those levels, then I don't want to fight the market. You never, ever want to fight the market. So what I want to do right now is take the time to thank everybody for coming out and attending the webinar this morning, and thank FX Street for hosting. I know that I'm right on the border of my allotted time here. So if anybody has any quick questions here, I'm certainly happy to answer them before I close out, but I know there's other webinars coming up. Now, again, I think we do have some pretty good opportunity coming up here for sure. And okay, let's see. Okay, yes, thank you to the FX Street. Do you look at the COT report? No, I find the COT report to be somewhat a bit lagging. I think it's okay to look at it, but I think a lot of this government data, you know what, guys, I have nothing to back up what I'm going to say other than price action. I am seeing that most of this data being somewhat skewed and that somebody already has it. And whenever these big moves happen, based around the FOMC, based around the non-farm payroll particularly, I'm telling you, I'm watching pairs like dollar yen, euro US, and clearly these people know somebody knows something. That's all I can say. And the real move happens before the announcement, and the actual announcement is nothing more than basically a knee-jerk reaction or a stop-loss hunt. That's what I'm seeing. So it's always good to just, before a big event, don't trade the big event. Trade leading up to it, because that's when you have a really good stable move. And then once the announcement came out, it's just like, oh, geez, like yesterday. when you really look at Janet Yellen's announcement and her language, there was not a whole lot of change there, other than that 6.5 unemployment thing being removed. She made it quite clear. I don't see the statement really being any different than any of the other statements that would signal a massive dollar rally. I just, I don't see it. So, but anyway, a lot of people are saying thank you for the webinar, and again, I want to thank you guys for coming out, supporting me, supporting FX Street, and I certainly look forward to seeing everybody on the next webinar presentation. Thank you.